Most people don't really know how much home they can actually afford. So here's the thing. When we're looking at how much home you can afford, it's not just about your income. It's also about how much debt you have, what your credit score is like, and how big of a down payment you can make. Those are kind of the big four factors when you're looking at buying a house or getting a mortgage. It's going to qualify you for a certain amount. Now, that doesn't mean just because you're qualified, that's what you should get. The truth is, you want to figure out what your monthly payment is comfortably and see what house that qualifies you for. Now, if that doesn't qualify you for the house you're looking for, then we need to do some calculations and figure out, does your credit score need to build up? Do you need a bigger down payment? Do you need to increase your income? Or maybe do you have too many debts? I'm going to link 2 calculators down below that you can play around with and find the numbers that work best for you. In this video, we're going to go over all 4 different types and figure out which one maybe you need to work on before you go get pre-approved. So if we start on income, there's definitely a bunch of different factors when it comes to income, and it also matters who you work with. If you're not just a normal W-2 employee and you have a business, or maybe you have some side hustles or different things, or maybe you earn commission income like I do. Commission income, you need at least 2 years of history before you can use it. I found that out the hard way when I was trying to get my next mortgage and I didn't have 2 years of commission work experience. Prior to that, I had a salary job and it was easy to calculate income. When your income's variable, like commission, we need a longer time horizon to judge through each season how much you're actually going to make. So once we figured that out, then we look at your debts. We're taking all the minimum payments of your debts, your car loans, your credit cards, maybe personal loans, student loans, anything that you owe to a bank. When we're looking at all the loans, we're adding up all those minimum payments and then subtracting that from your income. Now that income after all the debts is what we can actually use. With these 2 numbers in mind, we can start to get an idea of how much home we can afford. So there's 2 different ratios when we're looking at buying a home. You're looking at your front end ratio, which all that means is based on your income, how much is the mortgage payment in a percentage. Ideally, we don't want this to be over 40%. As a mortgage broker, we have a little more flexible guidelines. You can go up and down depending on the programs, but 40% I would say is a higher end of safe. And especially in California, we have to push that envelope a little more than other states do. Sometimes when you work with a bank, they will only qualify you for up to 28%. So there's a benefit of working with a mortgage broker or mortgage pro. They can actually qualify you for more because they're not restricted to just their bank's tight guidelines. They're able to go through multiple different wholesalers and find you the right deal. The second ratio is actually called the back end ratio, and that's the housing payment you're looking to afford plus all of the minimum debt payments you have. That is your overall debt to income. Your overall debt to income basically just means how much of your income every month is going to go to all of your debt payments plus your housing payment. And that's probably the most important ratio because we don't want that to be over 50%. If you go through an FHA loan, you can go a little bit higher than that, but we're really pushing the envelope either way. And I would say under 50% is on the safe side of any loan. Now, these might be aggressive numbers when you're looking at a bank, but for here in the mortgage broker space, for California, it's really important to know these numbers because here, your debt to income and maybe that housing payment might get up there to 40-50% very easily. So affordability is really important to figure out here in California. And if you haven't already, down below, I have 2 calculators. It's going to bring you to a website. You can play around with them, input in the home price you're looking at or input in the monthly payment you're looking at and some other factors based on interest rates and things like that you can kind of find out online based on the time you're watching this, and play around with it to figure out what is comfortable for you. Maybe you're okay with 40% of your monthly income going to that housing payment. Maybe you have a little extra debt and you can't afford that, so you need to go down and figure out how much home you can afford. Now, the other 2 things we're going to focus on is down payment and your credit score. Your down payment allows you to buy a bigger house because you're giving the money straight to the bank right away. You do have a minimum down based on your loan amount. It fluctuates. Sometimes there's loan programs and down payment assistant that you can get into a house for 0 or 1%. But then other times, or most of the time, you're looking at 3 to 5% minimum. And if you want private mortgage insurance off, which is an extra fee if you don't have 20% down. So you would need 20% to take off that private mortgage insurance. But the more of a down payment you give, the higher home you can afford because your loan amount is what matters to the bank after that down payment. So if you want to afford a really nice home, but you have a small income, you just have to have a lot of savings. Now, lastly is your credit score. Your credit score is important because it determines what level of rate you're going to get. So the lower your credit score is, the more more risky you seem as a borrower. The more risky you seem as a borrower, the less likely the bank wants to lend you money. So usually 780 is the cutoff for really good credit. Then it goes down to 720 in the 600s and in the 500s. The lower you get into these brackets that now you're paying a little extra interest for that loan, which now you won't qualify for as much because your credit score is not high enough. So here's my recommendation. If you're looking to buy a home in the next year or two, start looking at these numbers, play around with them, look at your credit score. You can actually get a free credit report if you go to freecreditreport.com. You're actually able to pull your credit for free once a year from all the major credit bureaus, and that'll give you an idea of where you need to start. You can also look at all your debt payments, see if you can pay them down in the next year. Play around with all these numbers and figure out what is your goal house to buy. What price range do you think it's going to be in? Think about what price you want to buy in, and then figure out from there, where do you need to adjust either your income, the debts you have, maybe a down payment or credit score to afford that. If you don't want to do this alone, you can call your local mortgage professional and they can go over these numbers with you and give you a plan of action. Highly recommend that. Don't do this alone, and they can actually steer you towards the best course of action. Maybe there's multiple reasons that you wouldn't qualify now, but somebody who does this every day can tell you exactly the best course of action and give you a plan. So what I would do is I would talk to a mortgage broker. If you look for a mortgage broker, they will be able to give you a plan of action. So over the next year or two, you can get to that goal house you want before you get pre-approved. Don't wait until you're getting ready to qualify to fix all this. Thanks for watching, guys. I'll see you next Monday.